Hello and welcome to Leviathan News. It's June 17th. I'm your host, Samuel McCullough.
And I'm DeFi Advisor. How are you, sir?
I'm good. How was your weekend, DeFi Advisor?
It was great, actually. Thank God. It was home. It was relaxing, sleeping, walking the dog out, and not that much other than that. And yesterday for us, it's not even a weekend. Like it's the first day of the week, so I was also like able to do my newsletter with some sharing videos lately at Another Day in Crypto on Substack. Also tried starting to use the article feature on X. I
Yeah,
really we should be exploring it.
I think
Actually,
we should do
I
that
think
for
both
Leviathan.
personally and also like on Leviathan. I see these getting a lot of traction, but also like exactly, I'm getting used to it because I'm not really sure exactly what will like how it will be seen. Never mind, I don't want to go too long about it. How was yours?
Well, it was good. It was good. Like coming back on the X thing, I think it's really incredible how the power of Twitter can shift people's views on an asset in just like a couple of hours, because all it takes is one tweet from one person to
Why?
distort.
What was the tweet that started it? By the way, and we're referring to the CVX price, guys. I guess.
Exactly. I'm looking for this tweet, but essentially somebody came out and said like Convex is trading below $2 or like right at $2. It's currently making about $150 million a year, most of which
Yeah.
is paid out to traders, and it's paying a 30% yield as well too, which is pretty I mean, and that's like real. That's not based on any sort of like future airdrops or anything. That's all fees. And with Michael's liquidation last week,
Yeah.
we might be seeing the end of the bear for value, because we all know that crypto hates value for some reason.
I think it's
And
only like because crypto is so young. Like it was like it's like my first few years of investing when I was really like, you just don't know. You only look at growth. You only look at like what can I buy, and tomorrow it's gonna 100x, and I'm gonna be so fucking rich and all
I
that.
know.
But like after a while, when you start listening to some grown-ups, and you're all like, oh my god, this guy is making like money without like he's making money for sure. He's not like wondering whether the price is going to go up or whatever. He's just sitting there and he's claiming like cash money being delivered to him. And all of a sudden, your mind, at least mine, it shifted to how do I get my positions big enough to be able to get like a meaningful amount of cash flow? And for me, it was like it's definitely my big mind shift.
So
Come, like
I
coming
think
up to my second actually bull that feels to be coming at some point. I think it's actually coming.
so. I believe this was a tweet. The Trend Shift Pro comes out and says, "We believe Convex is drastically undervalued here at $2. It's currently trading at a FTV to sales of 7, with annual revenues of $80 million and a market cap of 100.
That's an insanely low P ratio. I mean, yeah.
So Convex is taking in half their market cap in fees per year and has distributed $272 million to users.
That is insane.
Just pretty crazy. So they said they came out, they bought their first clip at $2, and they're going to buy more at $1.75. Never happened. And at $1.35, never going to happen after that. After this, Convex went on a tear, just absolutely crushed over the next 3 days.
Can you show a graph? Can you show a graph of this?
Yeah, I'm going to pull this up right now. It peaked
because it was really meaningful. It went like 100%. No, I think.
Yeah, it did. It had those lows of about just under $2, about $1.95 as the lows, and then within 24 hours, ripped to $4, repricing. Which I think we're going to see a lot for these like value trades, because again, like crypto hates value, and you can be
fair though, crypto hates value, and so do equities markets also hate value. Value has just been like generally shat on for the last like 15 years. So yeah, I'd like to think value will see a resurgence both, and I think it has been like post COVID. I see sort of like the rally in the commodities markets post COVID as to some degree a reflection of that, like a return to more earthiness and things that are tethered to real world value.
Yeah.
Hopefully, we'll see a reversal. I think both in the crypto market and just the markets more generally.
There's a great stock trading book, or like investing book that I read a while back, and essentially looked at the like hype stocks going all the way back from like the 1950s. So looking at, if it's 1950, would you rather buy IBM, which is building computers and changing the world, and it's the future of tech, at least in the 1950s, or something boring like oil, which has high capex, is like pretty looked down upon as a stock even back in the 1950s, but paid out nice dividends. And the conclusion they showed was that these tech-driven hype stocks or equities or even tokens as well too, they typically underperform over the long term because people are buying at such high valuations, high priced sales, high priced earnings, that it's difficult for them to make up that gap over the long term versus like value trades where all the value does is just have to do well. It kind of has to sit, and especially if you're getting paid dividends in a company like Convex or like these oil companies back in the 1950s, like Standard Oil, they just amass over time. And if you keep reinvesting in them, they do extremely well over the course of like 10, 20, 30 years.
I spent a summer working for a value fund called Verdad, started by this guy called Dan Rasmussen. I recommend reading some of his articles on PE if you haven't, but he is a staunch value proponent. He started a value fund. I think they started in like 2015 or something. There was a lot, like tech and growth had a lot longer to run. So they wound up, I think, being like extremely validated during COVID, or like with some of the bets. It kind of depends. I'm actually not sure how the performance has been the last couple of years, but they drilled into everyone's brain, everyone who was interning there. We read a lot of like research on value equities. They very into like the FAMA and French like 3-factor model. And a lot of the companies that the interns were, including myself, that we were like writing reports on and doing modeling on were all like, a medical device manufacturer with insanely, low price to earnings ratios, or just generally like mining businesses, very unsexy businesses, which I think gave me an aesthetic preference, at least at the time, for these sorts of like deeper value businesses, which generally are ignored or disliked by the market in this like hyper reflexive, hyper non-fundamentals based world that we live in. So
yeah, because attention fades at some point. Like valuations come back to earth. They always do. They always revert. Everything's been reverting. And so, if you're paying $1 to buy a perpetual income stream into the future, value seems like a right way to go. Maybe not for the short term, but
it also depends like on how much money you got. Because if you don't have enough money, then value investing is nice and all, but like,
well, no, that's not true. Everything compounds over time.
Time is the question that people like. But time is the bet. Like, or how much time are you willing to bet? You know what I mean? Because if you feel you only have $1,000,
well, I tend to
generate even like 50% on it.
But I tend to separate like my crypto stuff. Well, there's investing, which is like buy and never sell, and then there's crypto stuff, which is like, okay, maybe I'll hold for like a couple of months or a day.
But that's the whole point. Like the crypto, this value side within crypto, like for people like ourselves, I think is most interesting. You know what I mean?
Yeah.
Do you ever listen to Noah Seidman, Captain Rational?
I do. Yeah.
Like for me, he's the biggest influence, I think, on that part, other than some friends that I talk about too, who also watch his streams. But I think it's the whole point of, you can actually own some crypto assets and they're going to pay you. And once I actually figured it out, like for me, even though I'm still a very small investor, I'm already like into it, because I also think about like, okay, what's going to happen if all of a sudden like CRV or CVX 10x's as well, like what's going to happen to the cash flow from it as well. But who knows, honestly. And either way, like it's all about like finding like these protocols will actually like perform as meaningful services to have people actually use them and have a certain type of tokenomics that redelivers this value generated for the investors. I think it's going to be one of the most important investing strategies of our future.
Yeah.
I was going to say my worst trade of all time was a value trade that I just traded the wrong direction. This is a pretty brutal story. When I opened an account when I was 18, like a Fidelity account, or it was a Fidelity account, and I must have just impulsively bought a couple things and then completely lost track of it for several years until I went back. This was when I was dancing professionally before I went back to college. When I went back to college, I opened this account, which I had not looked at for years, and discovered that what I had actually invested in, clearly this was like I'd intended to execute on a full strategy, but I had only actually put through some of the trades. And it turns out my mix was 25% Exxon, 75% cash. That's what I was holding. And the 25% Exxon, the shares of Exxon that I had bought were, and I truly, like, I have no recollection of like having made this purchase. I don't know what came upon me. I don't know why the only equity that I thought to buy was ExxonMobil, but I bought it. I was just looking at the price chart. I bought it. It must have been like when I turned 18, so around 2014. And that was the peak until the post-COVID rally. If you look at the peak in 2013, 2014, I think I bought it at like $95 a share. And then when I reopened my account, I think I like panic sold it. Yeah, I just wrote it from the top to the very bottom. And since then it's recovered. If I just like held on, it would have been not a great trade, but I at least would have recovered what I put in. That was my worst trade of all time, was buying Exxon and at the Pico top and holding it into the very bottom of COVID. So that was my poor value trade.
I'm the worst growth trader, I think, probably anywhere. Really. I never know when to sell, Sam, you know what I mean? I never know when to sell, so I might as well just lock it because I won't sell it anyway.
I know. So today we're going to be exploring the intersection of TradFi and crypto. And today we have on a great guest, which is Caldora, who we've been really excited to get on here because she is building something extremely special at a protocol called Ostium. And I think that people say that stablecoins have been crypto's killer app over the past 10 years. It's seen widespread usage. Stablecoins are at about $150 billion of total supply, but it's not really true. Like the real killer app for crypto has been perpetual futures. These are doing trillions of dollars a year. Maybe $1 trillion a year, but a lot. There's billions of dollars, $10 to $15 billion on Binance and the other exchanges done daily, which is pretty incredible. And the funny thing is that these type of markets don't really exist in TradFi. Like, we love perpetual futures. They're a great product. They're super fun to use. You can get high leverage on it. They pay great funding rates. The funding rates are moving all around all the time. There's great strategies that you can do with the ARBs between different pairs, and they work really well between like spot markets and the perp markets. But nobody's come out and done a perpetual market yet for commodity futures, and that's where Ostium's coming in. DeFi Advisor, have you ever traded like commodity futures before?
I don't think so.
No.
I don't, like, for example, can you give me some examples? Maybe.
Yeah, like corn or oil or.
S&P. No, I haven't. But the only time I heard about these was with LandX, I think, which is also like a protocol that. But they specifically do it like I was interested of it because of the agricultural stuff, like because it's specifically for corn, wheat, soy,
soybeans.
Tokenized. I'm unsure what the product looks like today. I remember coming across them like a year or so ago, and they, I think, are doing like tokenized agricultural products. I'm not entirely sure what the like payout function looks like.
Yeah, I don't know if it's perps, like for sure. Like
no, it's not a perp. It's like I think they call it like a commodity bond. I'd have to. It's been a while since I took a look at what the product looks like, but we are also listing. We have agricultural commodities live on testnet today, and they'll be on mainnet as well. So,
Caldora, I just wanted to kind of start things out by asking, like, why are perpetuals so popular in crypto markets and just not seen anywhere else?
So they are seen in, so how do I put this? It's not that they don't exist. Perpetuals, like as they exist in crypto, don't exist anywhere else. There are instruments that have many similarities. And so when you talk to like old school FX guys and you explain perps to them, they're like, oh, this sounds exactly like
Like a CFD, right?
yeah, like a CFD. And there's other, it has different people, what equities people or FX people or commodities people call this sort of instrument, which high level, the way I would characterize it, and just to be clear, like there are a very clear difference between that and like perps, but is basically a cash settled instrument that pays you out where you don't ever own the underlying and you pay out the difference between the price that you had entered at, the price that you exited at, with some sort of fee, usually taken like some overnight fee for holding the position, or in the case of perps, like some funding rate.
Mm-hmm.
The core difference is that in those markets, there's no incentive like within the market itself. There's no incentive towards balance across like long and short, or the price of that sort of like cash settled instrument doesn't necessarily deviate from the price of the underlying market beyond some spread. So it doesn't float organically. So just to make that more concrete, instead of in a traditional perp, like on a Binance perp, the price of the perp, the mark price of the perp will differ from the index price of the underlying spot asset, and that free floating price is then modulated by a funding rate. With it is like the purpose of the funding rate is to converge that free floating price back down to the price of spot. I will also caveat and say there's sort of like a different on-chain perp model, which I think some might argue is not. There's some like meaningful differences between this like order book free floating perp price, which is more of like similar to the GMX model, where the purpose of the price of the perp does not actually fluctuate as much from the price of the underlying spot price, like from the underlying spot price. And the function of the funding rate is actually to converge long and short interest, rather than specifically like the objective function of the funding rate is not to reduce the price of that like perp to the spot, but to balance out long and short. These are small nuances. High level though, what's important to distinguish like the way the perp market works from these like other synthetic markets that exist in the traditional markets is that there is an incentive towards balance across both sides. And it's not just the platform extending basically like a line of credit to someone to open a position without any incentive towards someone to open the other side of that position. So it winds up being like a fundamentally different primitive with like different payout functions, different exchange, like a different set of incentive structures for like traders and for market makers. But the answer to your question is like, there are actually instruments in the traditional markets that are like similar to perps, but they lack this core feature of perpetuals, which is the funding rate, which incentivizes, it like sets up, I think, a better market structure and better incentivizes balance across the entire system. I think the other thing I wanted to mention was sorry, go ahead.
So I was just going to say, so like if you trade regular commodity futures, there's a physical settled commodities market where like I'm a corn grower and I'm out in my farm and I'm going to make a million. Wait, is that a lot? I mean, like a million bushels of corn, right? And so I know that my harvest is going to come in like September or October. I can go out and I can sell my corn using a future at that date, right? And that kind of like locks in the price for me. And that's typically how people use physical commodity futures, where like I grow my corn or oil or whatever, and then I deliver it to the market. You would, long time ago, you would see people bring actual commodity goods to Chicago, where they would settle the prices. But as technology has increased, we then shifted to before we get there, so each month may have a different price. So the price of corn in like September might be different than October. Yeah, they're all different expiries. As technology got a little bit better, they started introducing cash settled markets. So I could trade like gold is mostly traded as a cash settled instrument, and so I don't actually have to deliver the commodity here in this case. I just deliver cash at the end of expiry. And now with Ostium, we're getting to a point where we're going to be able to take all the cool things about the perpetuals market, which is 24/7. It has this cool funding rate. Everything's settled on an hourly or 8-hour basis, or however you want to make it, right? And you can bring that and introduce it for traders who want to trade these commodities, because they do. I mean, they're really popular. Like the amount of speculative trading on commodities where it's not physically delivered is quite high. It might even be bigger than the actual like physical trading itself. And
most of these, one other thing I want to just add there is we're focusing a lot on commodities, which I think is probably one of the most interesting places to focus on. And also we've spent probably the most like technical energy figuring out like the commodities. Creating a perp on a commodities market is substantially more complicated, especially for the ones that are where like the reference price that we're using, or like the spot reference price, is actually like a rolling front month future and not the spot market, because there's no liquid spot market. So we spent both the most like technical energy, and I think it's probably the most interesting. But I just want to caveat or say that the vision for what we're building is that every liquid market on earth can be traded as a perp. The high level is we think perps are like the 0 to 1 primitive in the space because of this shift towards like this better market structure, which is basically like core dependency is like on that funding rate, like contrasting that with these other synthetic markets I mentioned, the traditional markets. And we want to bring those markets to every market on earth. We want every asset that someone might want to trade to be tradable as a perp-like instrument. So we can talk more about like commodities specifically, but I just want to lead with commodities are not the only asset class we're focusing on. And we see them as sort of a tough nut to crack, and that's why we spend a lot of time on them. But they're only really the beginning of what we see as like a larger vision for every market on earth to be tradable as a perp.
How much of the trading in general in TradFi is done like on commodities, and how much on other assets? And like you can maybe like start sharing
on the
about
futures market,
different kinds of assets. Yeah, the perp markets or whatever they call it.
or the regular futures markets. I mean, they're massive. I mean, they're incredibly large.
Yeah, but like I mean, like for example, up till now we've only mentioned the commodities like agricultural stuff, right? But like, I'm sure that there are a lot of gold is a commodity as well, and oil.
Well,
and
even non-commodities. If you look at like one of the biggest futures markets in the world is the S&P 500. It's the deepest, most liquid,
how much money?
best market to trade. Like if you want to trade futures, you could just trade S&P futures all day, and it's incredibly liquid. You can deploy tens, hundreds of millions of dollars into it, in and out with low slippage, and there is no second best really when it comes to futures trading. So, I think that I want to ask is that when you start to get downstream of the actual assets themselves, so we talk about these huge futures markets, and you start to move downstream, even going from like physical to cash settled and then perps. How does that affect like pricing and slippage and market structure?
Are you talking going beyond like the core markets, or can you just rephrase your question?
Well, I mean, like, so you're essentially taking this 24/7 always on perpetual, and you're going to be applying it to like TradFi markets where they close on Fridays, they get holidays off.
Yep.
There's the stoppages in trading. Like, how do you reconcile those two things?
Yeah. So this is a great question, and I just want to caveat by saying that at Genesis, or in the very beginning, and this has been the case on testnet, will be the case on mainnet in the very beginning, you won't be able to open a new position while the underlying market is closed because of the market risk that creates. We are working towards, and eventually the vision is for these markets, like for the perp market, for these assets to be 24/7. But you're correct in identifying that there are very clear risks that can arise when you have these like price gaps that arise when the market reopens. And if you are the only venue for trading something out of market hours, you also have the risk of like adverse selection, where someone might, I mean, a good example would be the oil market, for instance. It could be, closed on the weekends, and on Saturday, some news comes out that is likely to have a major impact on the oil market. If you are the only venue for that trade to occur, you would wind up basically being like the only market for, or like liquid and open market that wasn't like some bilateral trading market.
We just saw this on Robinhood with GME, where three weeks or 2 weeks ago, where Robinhood had pre-market trading for GME. It got like max bid all the way up to $40, and then I think it settled on the day at like $20. So
so before I even get into like what are some ways that you can create a 24 market on this stuff, it's actually not trivial to figure out like how do you actually not have people be able to open a new trade over the weekend in a way that doesn't introduce a bunch of trust assumptions if you're building this on chain, because the default or like sort of status quo generally when there's been some experimentation with like listing, say FX or some of these commodities on chain, which has been done in sort of like a smaller, like not at scale. The default has been like basically to block trading on the front end, or sometimes to override like the Oracle price and set it to 0. But both of these solutions and like several others that I could talk about introduce a bunch of trust assumptions around just introduce trust assumptions generally, and also have the risk of like they're not scalable because they're much more prone to something going wrong. So just an example would be on the like just blocking trading on the front end is obviously like not a scalable solution. If you have some like erroneous price come through on the weekend and that happens to be like that's at a time when someone wants to submit a trade, they could just bypass the front end and go like interact directly with contracts. So you need a way of limiting trading initially. So it's like I would look at it as like 2 phases if you're dealing with these markets. And like this, I guess, should sort of be obvious from what I'm saying, but it is not as simple. You can't just shoehorn these like traditional markets into like a normal perp stacks. Like there's very specific things that you need to pay attention to and account for in the technical design of the DEX to be able to list these markets in a way that is like safe and scalable and accounts for their unique features. And so on this like market closure aspect, yeah, go ahead. You were going to say something.
I think that it's really interesting how crypto kind of like inverts everything. And we had on who was I guess the other day to come and talk about like, it was Anton from Hollyhell, essentially talking about how for stablecoin versus fiat payments, stablecoins, they have this like instant settlement, but then finality takes some time. But in the fiat payment world, finality is instant and then settlement takes some time. And so like you're trying to like butt heads with these 2 completely different types of instruments to like make them work at the end of the day. And it seems that there's some very similar characteristics between these on-chain perp markets that you're trying to build versus the like off-chain TradFi markets that have that you're trying to integrate.
Yeah. Yeah. And I mean, the other, probably another thing worth mentioning, right, is like because there's a reference market, right, we're not trying to, at least not in day one, have an exchange that is like becoming the de facto place for like settling an oil future, right? Like it's going to take a very long time, I think, before that sort of infrastructure is built on chain. We would ever transition towards a world where that would be the reference market. I think we'll get there, but certainly not today, and certainly not the next few years. And so we inherit, like we introduce properties, we are dealing with basically like blockchain properties, but are inheriting and need to account for the market structure issues or like elements of the market structure of the underlying market, which are, again, difficult to do in a way that is like minimizes trust assumptions and is scalable. I just want to, I guess, finish what I was saying about like the market closures, because you brought it up yourself, and just emphasizing that like having a scalable way of preventing trading during the weekends or when the underlying market is closed is not trivial. And basically the way that we've done this is by not introducing additional trust assumptions beyond those of the Oracle itself, which we like built out an Oracle network, which I can also talk more about if you want to. We basically store all the market hours data on IPFS, and then we feed it in through the nodes themselves, so that all of this is integrated into a single price report that the contracts can read from. So we don't have to have, everything is inherited from the price report, and we don't need a like additional block on the front end that goes beyond like the front end like reads itself from that daily data, stored data about the underlying market hours. So we allow people to update stop losses or take profits or top up their positions while the market is closed. So if some major news comes over the weekend, they're not going to get liquidated and have no like recourse, which we think is very important. But actually opening up a new trade, being able to open up like at the last Oracle price from Friday would obviously be very risky. And you also run into, even if you had even under like a free floating per price model, you basically need to have severe change, like substantial changes to the funding rates to make them much more aggressive, or have some overriding of the Oracle price in order to enable trading on the weekends. Because if you just have a funding rate, if you're just using the Friday reference price, if you're using a price that's like stale for 36 hours. That obviously introduces like risks, like counterparty risk into the system that we need like more data for, and I think more robust backtesting before we would introduce.
Governments love to go to war on Friday after market closure, and they also love to dump adverse news information into the market after everything closes.
I think the other thing I want to say is like we're rapidly hurtling towards a world with 24/7 trading. Like this is not just in crypto. Crypto is obviously like pushing the entire space, like all markets in that direction. But I don't know if you saw the like news recently. I think it was discussions at NYSE about 24/7 trading. I'm just gonna look this up right now. But
I saw that the other day actually. It makes sense, right?
Contemplating, there's a piece on NASDAQ which is contemplating 24/7 trading on NYSE.
I feel bad for those like junior traders who typically would get their Sundays off working their 150-hour weeks at their banks, now having to stay over on the weekends.
Yeah. It's not gonna be long before I think everyone is in this world that crypto is in today. So yeah.
Okay, so these are like mostly futures products. A lot of them come from US markets, but it's not going to be US people trading these products. What does it look like right now for like people outside the United States who want to get access to S&P futures and trade it? Like, is it a good market? Do they have like good market structure? Like, if I'm located in France and I want to trade the SPU, like, am I really getting a good price and execution there and can fill with size?
So I'll talk about, so this is where I think I'll link like the sort of synthetic market, the traditional synthetic market and the perps market. So the primary way that people get access, maybe let's not talk about the, but let's maybe mention, like talk about a Forex pair, for instance. Like if you want to bet on the yen, there's been a lot of disruption in the like USD yen market recently, given the sort of speculation around the BOJ intervening and defending the yen's price. If you want to bet on that, like how do you do that today outside the US? And this is where these like synthetic platforms that I mentioned, these like synthetic CFD platforms come in. So the high level, the market structure is one of these platforms go and source pricing. They source quotes from underlying data providers. That can be a bank or a liquidity provider. They add their own spread on top, and then they give the user that price. They usually have some sort of like line of credit or total directional exposure that they can take on, and they extend that. A trader can come in and execute immediately at that price that they're offering with that spread on top. There's sort of two models for how they manage risk. So this is where the core part of like the funding rate comes in that I mentioned. In this system, because there's a borrowing fee, there's usually like an overnight fee that people are paying to keep their positions overnight or for some longer period of time. So similar to, you can imagine like a GMX V1 borrowing fee. But the core difference is there's no incentive for someone else to come in and take the other side. The platform is basically taking on that directional risk. With the sort of the core like caveat being sort of two ways that they can manage that risk. And there's like what we call A book or B book. So B book is when you B book something, you basically are just taking on, you're not hedging any of that risk. You're letting anyone take on a position up until, some certain size on any of the markets, and you don't go and put in that position somewhere else in another market. A book is where you actually go and hedge that risk. So at some regular interval, you would go and look at, what is your net directional exposure on gold or oil or silver or the yen, and you go and route that trade yourself, like the platform does this themselves, to some liquidity provider. Depending on the platform, some of them will B-book almost everything. The smaller platforms will offer generally very, very high leverage and often wider spreads, and they'll usually B-book almost everything. So they're sort of directly assuming that traders will be wrong in the like mid to long term, usually in the short term as well. The larger platforms will typically A-book a larger proportion or sometimes all or most of their traders. But But what this basically introduces is like a market structure where traders do get the execution price. Like there's a spread on top, but there's not like a free floating price of the quote unquote perp or synthetic instrument for vis-a-vis the underlying market. But because there's no incentive towards balance, it's a fundamentally different market structure where the like platform itself is in most cases, if it is booking traders or a majority of traders, betting on like them not making any money, which we think a better market structure is, well, you have a funding rate, which is sometimes actually think like crypto has grokked and like might actually take some time for these market people to understand, where it has like a meaningful influence. Like just because you bet directionally correctly on the yen, if funding was insane, that can erode at your P&L, and sometimes that can, or the reverse. But it is like a different market structure people have to get used to, like factoring the funding rate into their P&L. But that incentivizes balance across the system in a way that just extending a line of credit basically for people to put on any trade, but not having any sort of rate that is influenced by the amount of like delta exposure in the system. It basically pits the platform against, in many cases, again, just want to caveat this by saying like if people book their positions, then this is much less of the case, but pits the exchange against the interest of traders, which is different, which we think is a worse market structure than basically having a funding rate to minimize that sort of directional exposure.
Yeah. And then additionally, all these FX shops that you're talking about, like some of them are like really notoriously dodgy. There's been a lot of blowups and just random seizures, or they just shut down overnight. And, you're just wiring your funds to their bank accounts. And, if they're shut down, then God knows how long it's going to take you to get your funds back. I think there's a real opportunity to set up these types of forex trading structures, as well as commodities and other types of futures contracts on chain, because again, like all the things that we talk about in crypto, it's transparent, it's open, it's verifiable. You can see who's taking the other side of the trade. You always know your counterparty, and hopefully this is what drives a lot of interest into Ostium over the next couple of years.
Yeah, I want to say, I think like we look at these sorts of markets and it's like a textbook case of the sort of market that we think would benefit from being brought on chain in like a trustless and decentralized way. Generally a like market structure where there's some risk or like common occurrence of an account getting shut down or people's trades being limited. One leg of your trade getting closed, for instance, if it's in the money. Those sorts of things, a market where that is depending on the platform, obviously, and I don't want to paint like, too broad of a picture, but definitely on many of the smaller platforms, this is a very, very frequent occurrence. This is exactly the sort of market that would benefit from being in an on-chain, trustless, transparent environment where it's not a black box for traders. They know what they're getting. It's not that the, platform doesn't want to be biased against you or promises won't be biased, that it can't be biased against you. And then effectively replacing this with this market structure that better distributes incentives and like prices risk across the different players in the system. Again, I sound like a broken record on the funding rate side, but
it matters. I mean, it matters. It really does matter.
That role, basically enabling that better distribution of like risk allocation across the system. So the other thing I wanted to say was actually, I'm now, this is maybe totally out of sync, but you'd mentioned something earlier about like why are perps so popular? Like why are they so popular in crypto? And I just want to say that they abstract away all the, like most of the time people just kind of want to bet like up, down, long, short with some level of leverage, depending on, their risk tolerance or their confidence in the position. Perps like abstract away all the complexity of like discrete month futures with varying expiries, or especially in the options market where there's not only, different expiries, there's also different strike prices. Understanding actually whether you're going to make money or not is not as simple as understanding whether the price is going to go up or down. There's all sorts of like implied vol implications that will impact whether you actually make money beyond just like the change in price of the asset that you're betting on. So I would actually say, people often point to like the size of the options market vis-a-vis the underlying spot market and use that as point to that when like making projections about the size of the options market in crypto. I definitely think the options market is going to grow, and it's like, by an order of magnitude, but I would argue that the reason the options market is so popular, mostly on the retail side, in the traditional markets is because it's like the only way to get convexity. If you're like a consumer, like a retail trader, especially like in a place like the US where you can't really take on any meaningful leverage on equities. And that's the only way to get these like convex, like non-linear payouts in those markets. And so I would say like, the options market is like the worst except for all the others. That's like that Churchill quote, like, democracy is the worst system except for all the others. And like the perps market sort of like solves a lot of those. It fills that demand for convexity while also offering the simplicity, like extreme simplicity for the end user. And then that's like why perps have been so popular. And so our view is like, if perps are, can you guys hear me? I don't know.
Yeah.
Okay. Our view is perps have clearly proven to be the killer instrument in crypto, or like the killer sort of synthetic, like non-spot instrument. If we can take that and apply it to like the largest and the most liquid markets on earth, this is an unbelievably huge market.
I fully agree with you as well too, because the markets that we're looking at trading, I mean, the S&P futures, gold, oil, I mean, these are global international markets that are doing, hundreds of billions of dollars a day, and the bond market as well.
The FX market, like the FX market's the largest and like the most liquid market in the world, right? Like I think the other thing I want to say is like, when we look at, this is more of like a go-to-market point, but when we look at like, actually, let me go even like further back what I'm going to say, right? Like, I think we have a core issue in crypto where centralized exchanges act as basically this like funnel, where like anyone who gets into DeFi is like a tiny subset of the people who ultimately are acquired as like new users into crypto by like Coinbase or Binance or OKX or any of the centralized exchanges. And there's this like tiny funnel of people who then actually wind up doing stuff on chain. I think that is set to change. I think we're at this inflection point. And I think this is actually a nice like callback to what we were talking about earlier in the pod about like value and sort of the return of value vis-a-vis growth. I see this sort of as like the flippening back to this is sort of a tongue-in-cheek term, but like the flappening, like the flippening back to apps. I think like we're entering the flappening. I would like to think so. And this, I think we're like at the first time, we're like the first point in the history of the space where the infrastructure and like the just general user interfaces, like the wallets or the smart wallets or account abstraction, gas abstraction, all this stuff has gotten good enough where you can actually build an application. If you like do all the integrations, you can build an application that is like more or less usable for a normie to like a normie that's like tech savvy. And so I think we'll have, I believe that like in the next 6 to 12 months, we will see the first wave applications that actually act as like a user's first point of contact with the space, not as some like end point of contact, like months or like years after they first interact with crypto through a centralized exchange, and only, under some edge case circumstance or like convinced to, or something bad happens to them on a centralized exchange and then they decide to like move on chain or like self-custody their money. So I think we are moving towards a time where applications have like a decent shot of being a first point of contact for a user with crypto, like on-chain applications. And in line with that, I would also say, I think there's not many moats in crypto. Like it's really hard to build a moat. Like code is open source, liquidity is super mercenary. The space is incredibly ADHD. Like people get distracted by the new sexy shiny thing all the time. So I think one of the only moats in the space, beyond like brand and not having been hacked and being around for long enough and being trustworthy, is being a user's first interaction. So like I think you could say like, why is MetaMask still by far the most popular wallet? Some people really like MetaMask. I would say there are better wallets out there. And I would say it's because it's like the first thing that people download and think things are like incredibly sticky. And so I think the like killer go-to-market tactic for any app in this cycle, where I think those apps like will be the first to onboard a user, is finding a set of users that is not currently on chain, like extending beyond this like PvP stealing each other's like 3,000 users that are doing stuff on chain. Is like finding a set of users that you think are proximate enough to the space or have some sort of like behavioral or aesthetic similarity to things in crypto that are not yet doing stuff on chain, and monopolizing that onboarding process and making those like the most sticky and the most like sticky users. And I think that is like the best mode that any application in this cycle will build. Yeah. And so threading this whole thing, when we look at like what would be some users that we think fulfill those criteria. Current like degen FX traders are literally, I think like, I don't know that there's a better set of sort of like user profiles or like ideal customer profiles to go after. Many of them onboard platforms using Binance. Like they onboard not with their bank account or a credit card, but like with Tether sent from Binance, like on Tron usually. Behaviorally, or like in terms of just like trading behavior, frequency of trading, like leverage, etc., very similar to a lot of the behavior in the crypto space. Yeah, I think those are probably like the two core things. But if we can successfully onboard like the contingent of degen FX traders that have interacted with a stablecoin but have never done anything on chain, I think that is an incredibly like powerful like mode, or like just a great thing. Like I have like I think that it would be a great thing for the space generally. Well, just to we need to like onboard more people on chain.
How are you addressing it? How are you guys gonna do it?
So a few things. So one thing is actually Telegram and like distribution channels. So a lot of so another thing I mentioned just in terms of like behavioral similarities or distribution channels is Telegram is very popular among this contingent of traders as well, as far as like Telegram channels where people are, KOLs or traders will be posting their screenshots of their trades. And people usually follow these channels, but getting a direct API integration into like where they trade is a lot more difficult. And there's basically this friction point between the like channels through which these trade discussions occur and like where the trading actually occurs. And a way you can bypass that.
Can also build a Telegram bot, by the way.
Telegram bot. I was just thinking that as well.
Yes.
Like
so,
people really like it. I don't know how much in the US they like it, but like I think that outside of the US, like many people, and maybe even there, I don't know, it's kind of great.
The success of like Bonk bot and the Hyperliquid bot are a great indication, I think, of what is to come. So I won't.
Yeah, I think the diversity of like mobile phone hardware globally is pretty much all captured in Telegram. Like if you can open Telegram on your phone, it sets like a baseline for what your app can do. And so like all the crazy features and high performance like websites that people like to build, sometimes they don't show up very well. And you may not have like great internet as well too. But if you have a bot that you can just execute through Telegram, it makes it super easy.
I think like Telegram is the protectiveness around like the app store, like the difficulty getting, especially like a crypto app listed on an app store, like less so for Android, but especially on the iOS, like the Apple Store, is I see Telegram as basically like they're building like a permissionless platform for anybody to spin up their own. If you have, I see Telegram as basically becoming like the universal app store, as opposed to you having to go through some like complex gated permissioned listing process. There's this permissionless process of anybody being able to spin up a bot for, maybe there's like more limited functionality and you have less control over the UI and like the customer experience because it's inherently embedded within the Telegram experience. But I think the benefits of like permissionlessness and easy like automatic distribution far outweigh any of the sort of limitations around customization when it comes to the end user experience interacting with the application.
So the last thing I wanted to touch on before we wrap up is just so we all know that crypto is really correlated. Like everything tracks Bitcoin, ETH even tracks Bitcoin, everything just tracks the price of Bitcoin every single day. And so a lot of these trading venues that you use, the perp markets, they're all kind of managing risk against this Bitcoin correlation and its up and down price movements. What I think is really cool about Ostium is that when you guys introduce all these different commodity markets, S&P futures, like all FX, like most of these markets are uncorrelated with each other, which really improves the risk management system of the actual like trading protocol. So if we talked about this on our pre-call, is that like OKX many years ago, I think it was 2017, allowed a trader to essentially get long like an incredible like $400 million worth of Bitcoin when the market was pretty small. and everybody had to take a haircut at the time because the like one trader wrecked their risk models. And this is not the only time. I can remember in GMX's early days, Andrew Kang took out a $50 million ETH long, and it wrecked P&L for a couple of weeks for all the GMX traders. And with a system like Ostium, where everything is uncorrelated, sometimes the yen is moving, sometimes oil is moving, sometimes S&P is moving, it helps balance out the system. So even if there's one huge move in a market, like S&P, or I don't know, the S&P jumps 3.5% on a day or something like that, it's not going to wreck the rest of traders who may be in a different market. And it helps keep that risk management system like really well balanced across the entire spectrum of assets that you're listing.
Yeah, this is a great point. I want to be clear, just for like transparency's sake, there are obviously risks in the system, and anyone who is like LPing into the pool is like, we're very transparent and open about those risks. And you could definitely have a situation where the directional balance is all going in one direction, and that's like moving against LPs. But the hope and the expectation based on all the back testing that we've done in the system is precisely as you said. It allows us to, so one, the assets are mostly either uncorrelated or anti-correlated to one another. There's a lot more, they don't all move aggressively in the same direction the way it happens if you have one of these like GMX pools with just crypto assets. And the downstream implication of that is like, not only do we think the pool can be much more capital efficient, but also that it changes the like sort of objective function or like design of the system. So I'll just contrast to GMX V1. I think V2 is a bit of a different animal because they have split pools, and what they optimized for in V2 was more basically segregating that risk into discrete pools, not concentrating them into one pool, because actually a lot of the sort of stuff that you described with like too many events where there was just too much cumulative like directional exposure that turned out poorly for LPs. So I'll just talk about V1. But if you look at the design, right, like the objective function, as I would describe it, of the fee design was to limit long risk. So because if you don't want to be the counterparty to something in crypto, it would generally be like a bunch of people going 3, 4, 5x long right before the market rips on a bunch of crypto assets that are all highly correlated. Like that is the worst. That is the thing you don't want to be the other side to. So the design of the system inherently took this into account and tried to like I call it sort of endogenous hedging, or like in system hedging, where the way they prevented or like minimized that sort of risk was by having the same assets that you could trade, having the same assets traded as listed. So even if someone made a lot of money going long ETH, presumably the ETH that was in that pool goes in the, also is same directional effect and mitigates some of that like risk from positions appreciating in value. That system that like, and then as a result, it did not have a funding rate, but had a borrowing fee instead. That system was all fundamentally predicated like on the fact that the risk, precisely as you said, is highly correlated across any crypto asset that you would have in that pool. Under our system, we have lots of, as you mentioned, like uncorrelated or anti-correlated assets, which basically means that the objective function, as opposed to being like just minimizing long risk, is just minimizing delta or like directional exposure in general, which is where like the funding rate comes in to balance out long and short. And as a result, we think like allows us to also have a more capital efficient system where like the relative like open interest that we can offer based on some amount of capital in the pool is larger, because the like risk of like the cumulative directional exposure of the pool going in a like particular direction that's all highly correlated is much, much lower. We wrote a piece, like a research piece on this. We termed it like the imbalance score. You're welcome to like find it in our blog. If you look up imbalance score, you'll find it. What we meant by that, like we basically developed this score called this imbalance score, which was designed to come up with like one cumulative, if you could have like one number that measured the total risk of the pool based on the directional, like based on the cumulative direction of traders across different assets and the correlations between assets, looking at like how that score would be different if the assets were a mix of like just FX and commodities, or FX and crypto, or just crypto, or commodities and crypto. And what we basically found is like a combination of these RWAs is like just across different asset classes is by far, you get the, like for the same level of risk, you get a lot more exposure and a lot more capital efficiency. So it's like another cool feature, I think, of the design today.
That's really cool. I just want to bring up one extreme example that we can wrap up, because I wanted to find out like how your guys' system would happen or would like operate. A couple of years ago, the oil price went negative, and some of these platforms, like the CFD platforms, had no way to price negative pricing. Like it just went to zero and it stopped. But then prices in the oil market went to like negative 40 or 60 or something like that. What would happen for like the oil, since you guys are tracking the front month oil contract? Like what happens there for traders? Do they just get like zeroed out, stops market trading, or can it go negative?
I mean, we would track the same. It would just be inverted basically. So if you went like long, you would be effectively short for that period of time. So, I mean, the simple answer is it would just basically like inverse. If the price is negative, it would inverse your exposure. I can like give you a more detailed answer, but effectively we would still be pulling in the price from the Oracle. So the price that you would reveal to the trader would be just like a negative price.
COVID was so weird. Like it really broke everything.
Yeah, that was a very, very crazy time in the markets. I don't know if you've ever read there was a really great like mini documentary on the set of traders in the UK who they made like $600 million in like a period of 4 days when oil went negative. Just a bunch of like lads outside London in some suburb. It's such a great, they tell the narrative of how they came to consensus on the market view and just absolutely like, shorted this thing into the ground. Yeah, it's a very cool story. There's some people who made out like bandits from that event.
Well, I'm gonna have to go find that documentary, and I'm really excited to come and see Ostium have its launch. You guys are in testnet now. When is the full product going to be out?
Announcement coming very soon, but you can expect to hear something major from us at ETHCC. If you're there, we'll be doing quite a number of things, which we'll be announcing in the next week.
He's actually going to be there.
Yeah, I'll be there. Well, so we'll cover this with Leviathan when you guys announce.
Man,
Awesome.
it would be so cool. It would be so cool.
Really nice.
Thanks, guys. This was awesome. Thanks for having me on.
Yeah, thanks for being here, Calidora, and thanks for everybody for being at home. DeFi Advisor, great to have you here.
You too, Sal. Thanks again. It was a lot of fun. Thank you, Calidora, for coming. Really enjoyed the talk. I'm looking forward to checking out Ostium.
Sounds good.